Good morning, Jags. This is Fahad. Today is Wednesday, December 23rd. Let's get started. Please note, a quick housekeeping note, that after today, the next time we're going to do conversations is going to be next week on Monday. So there's going to be a nice little break in the middle here with Christmas coming up. So enjoy the holidays and all that. Okay, so the chart that's in front of you is Digital Realty Trust, symbol DLR. This is a former Jaguar topic that we haven't covered in a while. We basically took it off our list a couple, almost more than 6 months ago, and pretty much stopped trading at that point. There has not been much discussion on this in front of clients and such. But now I'm taking a look at this from another angle. Yesterday, I saw some pickup in short-term call buying into the stock. And I believe that could be potentially a start of fresh new buying to come in the next coming days and couple of weeks, where we could see more aggressive bets start to pile on. The chart is finally turning around and is looking very, very good here as it takes this new leg higher. Purely speaking, if you look at this chart, this is the downtrending resistance. We have a crystal clear breakout through this with a very strong candle yesterday. MACD is turning higher, lots and lots of room to run for this. RSI in just the last couple of days has sharply lifted higher from 30 to 55, and that's telling you the relative strength is telling you that this thing is heading higher. Also, here's another technical look if you want to focus on stock charts. So these are the levels that I'm watching. So you can see we got the RSI bull cross, we got the MACD bull cross, we got volume surging sharply, although some of this was driven by quadruple witching, which was last Friday. As this thing takes this next leg higher, it closed at 138 yesterday. My first target is $146 per share. It's going to face some VOP resistance at that level. If it clears that, I think it gets into 150 plus, possibly rising to 151, 152, and then we'll see if this can make it all the way back to new 52-week high. So I think there's room for this stock to run in coming weeks. Now, with that said, there is some important things that you need to know fundamentally speaking. The reason why this stock has been down is really nothing more than just a simple factor of rotation in the market. REITs generally have not been performing very well. The whole sector, whether it's commercial REITs on the industrial side or warehousing or digital REITs or really any kind of REIT, the whole complex has seen a lot of money rotating out of the sector as the money has gone into spots that provide better beta, higher growth, and improve market returns, generally speaking. But when I'm looking at this company's last earnings report, which came out over here on October 29, followed by a week later, company hosted an event called Marketplace Live. And in that event, the CEO of the company provided even more color as to what they're seeing in the background. The tidbits of information that came out from that have a very, very positive landscape to that. So for example, this company provided further details for its platform called Platform Digital and their go-to market strategy. And one of the key questions that the analysts have had from DLR in the last few quarters is that given the low level of available supply for DLR, because 94% of their REIT is already fully leased out, so they don't really have any kind of capacity. And in the developed markets, such as United States and the key cities in the United States, as well as in Europe, where the company has presence, 100% of all of their capacity is already pre-leased. The question becomes where the growth is going to come from. Either they're going to have to build out more capacity because the data-driven economy continues to accelerate in this COVID world, or they're going to have to do some tuck-in acquisitions. That has been a main key questions for this company. The thing that the management surprised us in this Marketplace Live event is that their Chicago facility actually still has tremendous amount of growth that they could still have. It was actually the only spot in the country where it was not fully leased out, and they believe that they can very quickly expand that facility to get to satisfy the customer rising demand. And this is after several years of lull performance in Chicago interest. Management mentioned that they're seeing increased interest from CSPs and they also see the smaller size deals get done much quicker in the fourth quarter of 2020, and they expect that to continue in the first quarter of 2021. In the rest of North America, Toronto has been a busy segment for the market because of the legacy DFT assets that the company has. Dallas, on the other hand, the facility over there is seeing what they call, I quote, a strong activity, and northern New Jersey has been seeing strong financial for small to medium size sub of 1 megawatt deployments. So almost every part of the company's major markets, Dallas, New Jersey, Chicago, and Toronto in North America, are all seeing above average or more than above normal activity and request. In the emerging market segment, and particularly in Europe as well, in Frankfurt specifically, they called out, they see that market growing at a much faster growth rate going into fourth quarter of 2020 and then well into 2021 versus what they saw previously part of this year. And they believe that over time in 2021, this is going to translate into similar kind of a strong activity as Frankfurt market starts to reach its max capacity. They're going to see Zurich, Madrid, and Vienna all basically catching up to Frankfurt. They also, lastly, one thing they mentioned was that the enterprise segment has remained strong despite the pandemic. I will quote also here something that came from Stifel Research back on November 17, which seems to be right on the money compared to what the management said in this presentation. They said that, I quote, unlike some competitors that have highlighted elongated sales cycle, DLR has seen continued success among this segment. Many of the new logos within the enterprise segment are smaller size deal, and Intercion acquisition has been a strong contributor within this segment. The integration efforts remain on track, although the pandemic has provided some unique challenges. However, management believes both sides are integrating well, including people, process, and best practices. Reminder that this company, DLR, ended up acquiring INXN, which was another beautiful play a long time ago. So this acquisition was closed back in March. And I think that had been one of the key reasons, the integration of that, why the stock had a lackluster performance now for the past 9 months, which has now finally come to an end. So these are the most important data points that we have learned from this, and I believe over time we're going to learn even more, getting specific channel checks for the fourth quarter as well as we get close to the earnings cycle. Chart is breaking out, and some short-term call option buying has been picking up. So look for this to make a move all the way back to 150 plus. That's it from me, Jay.
Morning, everyone. So today I just want to refresh and update on a recent homepage article / weekend research write-up, and that would be Century Casinos. Ticker is CNTY. It was posted to the homepage back on November 7th, and then on November 8th it was published in the weekend research. So this is a regional casino operator that as of Q3 did 66% of its revenue here in the United States. And breaking that down by state, Colorado makes up 11% of that revenue. That comes right behind West Virginia and Missouri. Focusing on Colorado, they operate 2 establishments, the Century Casino and Hotel Cripple Creek and the Century Casino and Hotel Central City. In Q3, the company reported that net operating revenue was up 13%, adjusted EBITDA more than doubled, and its EBITDA margin jumped from 25% to 46%. In addition, they also announced that their third sports betting partnership was concluded with a company called Tipico. Another item that was discussed in Q3 or on the conference call was Amendment 77, which was passed in early November. What this was, basically a yes vote, supported allowing voters in Central City, Blackhawk, and Cripple Creek, the only towns where gaming is legal in Colorado, to 1, approve a maximum single bet limit of any amount and expand allowable game types in addition to slot machines, blackjack, poker, roulette, and craps. When asked about this amendment, the potential opportunity in the Q&A session, management pointed to possibly end of Q1, early Q2 as when the results will start to show. About an hour ago, Chronicle posted an article that essentially channel checks from the state of Colorado. More specifically, for the month of November, they said the state brought in $231.2 million, and that was from the Department of Revenue. That was a 9.7 increase over the $210.7 million in October. And then also in November, the state collected $793,000 in taxes from sports betting operators. This was a small dip from October, but it was significantly higher than the $69,000 in the month of September. So basically, I think what we're seeing is this amendment that had passed is proving to be, is acting as a tailwind for the company rather sooner than management had anticipated based on their commentary on the Q3 call.
These are record wagering in Colorado Sportsbook. Yeah. The November read through or the data that just came out, these numbers are pretty strong. For example, there's a chart over here of the total handle. Take a look at this. Actually, these are this is November. So here is the May handle was 25 million, June 38, July 59, August 128, September 207, October 210, and November 231. That's so these are pretty strong across all categories in Colorado. So this is a very positive read through for a name like this. Here's two ways of looking at it. You have two charts over here. Basically, in both of these cases, what it's showing is really just a consolidation pattern after a modest decline. Remember this rally that we saw from $5.80 all the way to $7 was rather on high volume. And then after that, a modest decline and a potential wedge formation. I would expect with the news out like that, there could be a potential breakout coming with a new leg higher that carries the stock back to $7 per share. So definitely one to watch. And folks, here's the article on November 7th that was posted by Jay. Worth reading it. There's a lot of important information here if you have interest in this stock. Good stuff. Yep. Chronicle.
Good morning. Today I'd like to talk about home building because I think it's time to start looking for long opportunities in this sector again. So to give a bit of background, several weeks ago I pointed out internally that I was beginning to notice a lot of home building and related stocks that simply stopped responding to strong housing data. Like if we were to pull up the chart of any of these builders, whether it's Lennar or D.R. Horton or Toll Brothers, like if we just pick one and pull up the chart, we'll notice that these stocks stopped going up around October and they began to underperform. Meanwhile, if we look at the latest macro data, everything from home sales data to building permits to NAHB, they're all still going strong. So you might be wondering why on earth the home building stocks are no longer responding. I think there are two reasons for this. First reason is, if you notice in October, that was when US rates and treasury yields began to inflect higher and the curve continued to steepen, because that was when we were starting to get all sorts of positive vaccine developments. So I think that may have resulted in some reflexive shedding of long exposure in these stocks, because home building has traditionally been a rate sensitive industry. Like for example, if we look at this chart that I shared, which shows Lennar stock and the 10-year treasury rate, which is a popular proxy for the risk-free rate, we can see that when rates started to go up, Lennar stock began to struggle. That's on the other one, the other slide. And if we do the same exercise for the other builders, it's the same pattern. So that's the first reason. Now, my other reason for this underperformance is because of general portfolio rotation. Because if you remember, back at the start of Q4 is when we began seeing an aggressive outflow of capital from all the growth in tech stocks that were beneficiaries of COVID-19 into value and cyclicals. And the thing is, home building was one of the sectors that also saw a lot of tremendous outperformance during the first half. So I think part of this is also to do with profit taking, because the upside was no longer as attractive compared to the value stocks, which were going up like 50 to 100% or even more in the space of several weeks. So basically, people saw no harm in getting out of the housing stocks and putting that money into value. So that's the explanation I would give for the recent weakness. But that said, the other side of the story is that even though this sector has underperformed for a couple months now, it's not exactly sold off. It's actually held quite steady. And in fact, some of these stocks, which are not related to actual construction, but are more to do with renovations or gardening or mattresses, like if we look at the charts of Trex, Scott's Miracle Grow, or Tempur Sealy, we can see these stocks are still going very strong. They didn't come under any pressure at all. However, over the last several days, what I'm noticing, and I think you're noticing as well, Fahad, that the price action in some of the traditional builders like Lennar and Taylor Morrison, the price action in some of these builders has started to look better. And I've been asking myself, even if rates were to increase, how high can they actually go over the next year? I can't imagine a scenario where we're going to see Fed funds rate at 2%. I just don't see it happening. And also, as we've been saying all year, there's still a lot of home building that needs to be done for supply to catch up with demand. Because for almost a decade following the GFC, everyone was too afraid to build, which is why consensus has been continuing to have buy ratings and recently raising their price targets across the sector. And then lastly, on top of that, I would also add that it's worth keeping an eye on the potential for student loan forgiveness and additional tax credits for first-time buyers of homes, because those sorts of policies would open the door for even more demand supply imbalance. Okay, so that's the high-level picture. Now, in terms of specific companies, I know we made an investing recommendation a couple months ago on St. Joe, symbol JOE, which has been a monster for us. But obviously, if you've missed the move, you don't want to be buying right now. But in terms of new setups, personally, I want to go for something with a lower market cap and higher beta compared to Lennar and D.R. Horton. And so I'm currently looking at an Arizona-based regional developer called Meritage Homes, symbol MTH. I think they're going to continue to be a beneficiary of migration trends from California. And in terms of regional building permits data, Arizona continues to lead the mountain states in terms of approvals. Both of these should continue to act as tailwinds for backlogs and deliveries after the company handsomely beat on every metric for both quarter and guidance back in October. And management has said they continue to see strength, especially in entry level. Now, looking at the chart of MTH, we can see the stock started to pull back in October, just like all its peers. But right now, it's kind of settling down and building a base with some bullish RSI diversions. And the way I'm personally looking to play this is I'm going to go ahead and open a half size position just in case it starts to take off. But at the same time, what I'm hoping for is for the stock to continue drifting lower towards that $80 support so that I can put on the remaining half and lower my average entry. As for the target, I'm aiming for a revisit of the recent high of about 112. And so that's going to give me a higher anticipated return compared to getting long the larger caps like say Lennar or D.R. Horton or Home Depot in terms of bang for buck.
Very interesting stuff. Another look at home builders. Meritage Home has seen previously some upside call option activity as well. But aside from all of that, we're going to see more of that, I'm sure, going forward from here. But I actually love this technical picture. A lot of the times what I look for is basically stocks that from a swing long entry standpoint, ones that have pulled back, built a base, continue to consolidate, because what that leads us is to a potential decline after a prolonged period of basing formation, a decline in implied volatility, which results in much cheaper call options to buy on the weakness. And also it creates a very low cost or low risk entry, I should say, because we know exactly where you need to put your stop loss, because that you know exactly where it's building the base. And that's essentially the case over here. This thing, as long as, in my view, somewhere between $80 to $85 per share, if it continues to hold that level, which is pretty much right in line where you believe, where your technical line up, It provides a very low cost entry or low risk entry for potential reversal back all the way up to $112, $115 per share, especially if we're going to see these kind of a strong housing trends that you have pointed out. And this picture particularly, which is about how the migrants have been a big boon to Arizona, California, and many others, clearly continues to be a positive. The only thing that I will point out is really pay close attention to the interest rate picture, TLT in particular. If TLT starts to spike from here and it goes from 157 to 165 or even more, that would be hugely positive, because rising TLT means that the 10-year bond yield is actually coming down. So in terms of a specific catalyst, if you're looking for a specific catalyst, what could move the housing sector higher into breakout, and not just Meritage Home, MTH, but also if you look at Toll Brothers, which has now spent about 4 months consolidating in a tight range, and similarly with DHI, 4 or 5 months here, Lennar, 4 or 5 months over here. All of these stocks could potentially break out if TLT starts to, not in a spiky fashion, but rather a steady move higher all the way to 165. That's going to move the interest rates lower on the 10-year bond yield down to potentially from 0.92% currently back to 0.8 or even 0.75%, providing a further housing boom to all of these areas. So that would be the one catalyst. Watch TLT, how it's behaving, and I think that could then translate into a strong play for all of these housing stocks. Great stuff. All right, folks, we're going to stop over here. Everybody have a Merry Christmas and have a great long weekend. Enjoy the festivities. And after today, we will see you on Monday. That's it from us. See you in the chat room later today.